Yeah, so Upstart is an AI lending company at heart. Our mission is to offer consumers the best rates and best process for every category of consumer product. Fundamentally, something like 80-ish% of Americans actually repay their loans on time with no problems. But only about 50% of Americans are considered prime credit based on their credit scores and traditional credit reports. It's like, you want credit when you need it. No matter what you think about AI, whether you're an enthusiast or not enthusiast, I think you're just going to have to look at the numbers and come to terms with reality that this is the new way lending is done.
Hello, everyone. Today we're joined by Paul Gu, co-founder and CTO of Upstart, the AI lending marketplace behind more than 100 bank and credit union partners. Upstart just posted triple-digit revenue growth and return to profitability in Q2, with 92% of loans fully automated and conversion up to approximately 24%. Paul, welcome to the show.
Thanks, Ed. Great to be here.
Are you calling from your HQ at the moment? Is this the background?
No. This is my home office,
nice.
built for the digital world.
Whereabouts are you based? America?
Yeah, I spend most of my time right outside Salt Lake in the US.
Okay. Oh, nice. That's cool. Are the team spread out over the country, or?
Yeah, we've got people in almost all 50 states. Really, over the course of COVID, we discovered that you could get incredible talent by hiring all over. And I think for companies that hit their growth spurt around 2021, 2022, you just ended up with a great spread of talent everywhere.
Nice. So you've maintained that going forward. This is your structure for how the company operates, basically.
Yeah, we have a working model that we call digital first, where we do hire people everywhere across the country, and we think the best talent can be all over the place. But we also really believe in in-person work. So we bring teams together on an almost once a month basis to spend time together in person. So people do launches together. They can do kind of like intense collaborations or just spending time getting to know your coworkers. We think that's really important. And then the math actually pencils if you think about there's travel cost versus office cost. And especially, if the office cost was going to be in a really expensive place, the math actually works just great.
Yeah, okay. And so when they come to meet up, do you hire like an event spaces because you don't have an office, or?
Yeah, so we actually do have some office spaces that pretty regularly, because teams are always gathering on a regular cadence, the offices are always being used, but it's not like every team at the same time. So we've got offices sort of in a few places across the country. But yeah, we also do event spaces for larger gatherings. And, once a year, we bring the whole company together. And then a couple times a year, big chunks of the company.
Amazing. And can you just touch on your background as well? Because I believe Yale and then pretty much straight into Upstart.
Yeah, that's right. I don't have a terribly long life story to share before Upstart. But yeah, I was at Yale. I was doing a double in computer science and in econ. And I dropped out to do Peter Thiel's 20 under 20 program, the so-called Thiel Fellowship. So the first year of that program. And so I dropped out. I spent a little bit of time at this quant fund called D.E. Shaw, and then pretty quickly pivoted to thinking about problems really at the intersection of machine learning and problems that would have an impact on real people. I always felt like there was just an incredible amount of brain power and compute power at D.E. Shaw and places like it that were just being applied to this super specific problem of arbitraging securities prices. Yeah. And it just seemed to me like if you could bring the same amount of intelligence to bear on a problem that would actually affect people's lives in some real way, that it would be pretty incredible. And so I ended up thinking about what's the sort of adjacent problem that regular people have. And you pretty quickly get to this problem of access to money. And with a couple steps and skips, we ended up finding our way to the business that we're in now, which is consumer credit and the problem of how you make it so that everyone can access consumer credit and access it instantly, easily, in sort of both a good way and ultimately with a good rate.
Mm-hmm. And so can you touch on briefly just the product suite Upstart and what you offer the consumers?
Yeah. So Upstart is an AI lending company at heart. So we see ourselves first and foremost as a technology company, but of course we actually are also importantly a consumer-facing company, and that's because consumers go to upstart.com to look for credit, and our mission is to offer consumers the best rates and best process for every category of consumer product. Today, We have unsecured consumer loans, usually called personal loans. We have auto refi, we have auto purchase, and we have HELOC. And in the near future, we expect to round out and complete the suite of products that consumers generally care about for credit.
And the main reason that consumers will come to you is because you're using these AI models to hopefully deliver lower costs for them for accessing credit. Is that right?
Yeah, that's right. So the motivation behind the company and the reason this works, you might think, well, how is it that you could just give everybody lower rates? And of course, the precise answer is we can't give literally everybody a lower rate, because then you would just end up with underperforming loans. And of course, there are people out there who will try to do that once in a while. It never ends well.
Yeah.
The thing that we're actually doing is what we call better separation. And what that means is there's always going to be some people that you didn't think would pay back that pay back, and there's going to be some people that you thought would pay back that don't pay you back, right? And there's errors in both directions. And all kinds of models have these kinds of errors. But in lending, the thing that we discovered 10 or so years ago when we started this was that there's an incredible amount of error. The vast majority of decisions are erroneous in both directions. And that's because fundamentally, it turns out to be the case that something like 80-ish% of Americans, if you actually were to do kind of a pure back test, actually repay their loans on time with no problems. But only about 50% of Americans are considered prime credit based on their credit scores and traditional credit reports. So if you're to pull a bureau report and use traditional scoring, whether that's a FICO or something else, you end up thinking, okay, only half of Americans should qualify for bank quality credit. And there's a whole nother third of the country that would have been able to pay you back, but you would sort of erroneously disqualify. Now, the people that have access to bank quality credit, generally people with high credit scores, long credit histories, et cetera, actually, it turns out that there's a small fraction of them that also still can't pay back those loans. And so you've got people that banks are giving really low rates to who are nonetheless defaulting. And you've got people that banks are completely turning away or have to go to payday or other really high interest rate options that are actually would have been perfectly good borrowers. And so it's our sort of mission to solve both problems. And when you get better separation that way in both populations, you can actually get big gains. So in the population of people that banks are approving, you can actually get to lower APRs for the people that actually will repay because you're pulling the sort of defaulters out of the pool. Yeah. And then, of course, for the people that are just erroneously rejected, those people can be pulled into the approval set. And so you can get dramatically higher approval rates and lower APRs. And that's what we offer the end consumer. And it's also what we offer through banks. So a bank can come to us and work with our technology and offer all of those benefits to their customers and to future ones.
Amazing. And are you able to give a recent real life example of how your AI has helped someone get credit that they wouldn't have got before? Is there some sort of story you can give there?
Yeah, people always love specific borrower stories. I think I don't have a good one right offhand, but there are like literally every day, like hundreds of people write their story on Trustpilot. As I think it's like 60,000 of them, and probably like 20,000 of them will talk about their experience where they either their next best option was some kind of payday loan. They tried 3 banks. Even a bank that they've been using as a customer for the last 10 years, turn them down, or the bank doesn't offer the kind of credit that they need, or that they were nominally able to get approved for a loan, but then they were faced with sort of this crazy process that involved uploading all sorts of documents, and it seemed to be sort of a never-ending labyrinth of requests to verify, if their income is a little non-traditional, or they have something complicated in their past credit history that just turn into these sort of really long processes. And people are when they need credit are generally looking to spend many days or weeks kind of filling out paperwork. It's like you want credit when you need it.
Yeah. And so as I mentioned, you work with 100 banks and credit unions over, and they obviously come to you because you help them save money with more accurate loans. How do you maintain that competitive advantage moving forward? Like, how do your values in your AI and how accurately you can do this, and how do you do that going forward?
Yeah. Well, number one thing is we continue investing in the AI to make it better every day. It gets better in a few different ways. One is that you can think of it as it gets deeper and it gets wider. The deeper, it just means like any kind of model company, like nowadays people have good familiarity with LLM based companies. And of course, they're always releasing new generation versions of the models that have more training data, sort of more sophisticated sort of model architectures, more compute. And there's exactly the same dynamic in lending, where our models every generation are upgrading across all of those dimensions. And those dimensions actually have a lot of synergies with each other, where you can't really just have more columns of data without more rows. You can't just like throw more compute at the problem unless you have a more more data or a more powerful architecture to take advantage of the compute. But conversely, if you don't have the compute, you just things don't quite work. In our world, because we have a very process sensitive consumer that comes to upstart.com, they are expecting to get a loan in real time. It's not like you can take a really long time to process a decision. So you've got latency constraints. And so basically all of these kind of like technology problems and data problems together create a pretty rich space for upgrading the models. And so that's something we're constantly doing. And actually it drives the majority of growth in the core business. So that's a very important dimension for us, is making the AI deeper and better. Then there's this other dimension, which is applying AI to virtually everything that we do. When we started the company, we really only applied it to one area, and that was the core credit decision, which was how do we approve more people at lower APRs? We did a good job of that. But over the years, we've realized that there's actually enormous potential to apply AI to the whole rest of the lending process. And so we started with the actual process of verification of a loan. Today, it's about 92% of all our loans are what we call fully automated. That means that neither manual work had to be done on the borrower side or on Upstart side. And so obviously that has both cost advantages, which can be passed through to the borrower, but also it's just a way better experience for the consumer who's actually getting a loan. Mm-hmm. We've started applying it to the servicing of loans, which can help people sort of structure their payments and timing and all that to be kind of right place, right time. And the second order effect of that is you get much higher repayment rates. And of course, higher repayment rates leads to lower default rates, which means, again, lower loss rates that you have to pass through to the APRs of the consumer. We've, of course, invested in applying AI to the actual marketing and targeting of loans so that you can reach the right people who actually need the product at the right time. And in our case, that's a really extra interesting problem, because if you're going to do differentiated decisioning, then you kind of need an equally sophisticated way to do targeting. Otherwise, you can't find the people who would benefit the most from the differentiated targeting. And so we've had to invest a pretty serious amount of effort in our machine learning teams on the targeting and marketing side. So all of those, I would say, are newer areas for us. Some of them are a few years old. Some of them are just getting started, but a lot of rich surface area. And then, on the other side of the ledger is like, what's the rest of the market doing? And I think for better and worse, I think there continues to be, a fair amount of reticence to move quickly and decisively. And I do think that, with the pace of AI, it's one of these things where if you're not going to be both feet in, going 100%, you're basically just not going to get anywhere. Yeah. And I think just the other day we saw on CNBC that the CEO of FICO, a really, really successful company, much larger than us certainly, but he was on CNBC just saying that you can't use AI in underwriting because it's a quote unquote black box.
Yeah.
And agree or disagree. I mean, we obviously disagree, but like when people ask us like, how do you know that everyone else isn't doing the same thing? It's just like, well, they're literally telling you you're not allowed to do it. And so that's how we know.
So when do you think AI will be used in underwriting properly?
Yeah, I think it's going to come pretty quickly here over probably the next 5 years or so. I think a few tailwinds are combining to make that happen. But I think ultimately, the thing that really is going to make it proven out is just like we've had this great success doing this in unsecured consumer loans, but unsecured consumer loans, frankly, are only a very small part of the market. I mean, if you were to ask a large bank, they would say that is an irrelevant part of their business, an irrelevant part of the portfolio. Maybe they don't even offer the product or don't care, right? Because in the grand scheme of consumer credit, you think about like auto and homes and cards and all the products, like personal loans are sort of a rounding error. And that's where we spent the first almost decade of our business focused on. And really only in the last couple of years, we started to build out the sort of products that the vast majority of the sort of consumer credit ecosystem is in. But essentially, they've got all the same problems where you either need to apply AI to get wins in credit decisioning, or you need to apply it to get wins in verification and automating the process. And the moment that in auto you're suddenly able to double approval rates, or in home you're able to have a 90% rate of loans being fully automated. I mean, it's so transformative in lending that I think no matter what you think about AI, whether you're an enthusiast or not enthusiast, I think you're just going to have to look at the numbers and come to terms with reality that this is the new way lending is done.
Yeah. And so how established are you in those new markets now? So in home equity loans, for example.
Yeah, so each one is a little different. Home is probably our newest product that is in market. So it's relatively nascent for us today. We have a HELOC product, but we are not yet in purchase mortgage, which is of course the sort of the big part of the market. Yeah. We're not yet in refi, which is sometimes really big, sometimes less big, depending on interest rates. But HELOC is a really good testing ground for us because HELOC is in many ways a halfway step between a personal loan and a purchase mortgage, but it has a lot of the same parts of the process that you have to automate in terms of anything about titles and liens, managing co-borrowers, like all the things that you would have to do on a purchase mortgage. But you get to do it sort of on a loan where you get training data a little bit faster, a little bit more efficiently because the loans aren't quite as long dated and they aren't quite as big. And of course there is, you don't have to deal with quite all of the problems. And so it's a really good sort of first step for us. And then we'll build out towards the whole rest of the home market. Auto, we have a little bit more time on. So we started first in auto refi, and then we added an auto purchase product. And so if you were to go to one of many hundreds of dealerships today, you could find an Upstart powered loan. And the differentiated thing about what we're doing in auto is that it's not like with any kind of lending product that you could find at the car dealership where you find it through the traditional market ecosystem. We've actually sort of built out our own lending platform that dealerships use. And that platform, while it's a bit of a sort of longer journey to build up market share because you can't immediately borrow from the distribution network of the sort of existing ecosystem, you get to sort of, I think, reimagine the process from scratch in a way that could allow for the possibility of a dramatically simpler and faster process, one where you could gather more signal on the borrower and therefore make a much smarter, more accurate underwriting decision. And again, therefore get to higher approval, lower APR. And ultimately, that means more space for the dealer to be able to sell cars and sell the products that they need to sell.
Yeah, that's quite amazing. I'd never realized that how big the total addressable market is for loans and how small a section you've started on. There's quite an exciting sort of potential trajectory there.
Yeah, absolutely. Lending is an enormous part of the market. We think it's in some sense the entire source of profits for the whole financial sector.
Yeah. Just coming back to something else you mentioned earlier, 92% of loans are fully automated with AI. What's in the last 8% that still needs people? Would you eventually think they'll be automated, or there'll always be a percentage that have some human element to it?
The last 8% is basically fraud.
Okay.
Yeah. Basically fraud. So of course, there are always, I guess I mean, in a more serious way, I mean, of course, there are like always people that are trying to defraud you. If you're giving away money, then someone always wants your money. And a big part of what you have to do is combat that. And so why is it that we can't have 100% of all loans be processed fully automatically? Well, the sort of the fundamental limiting constraint is that you have a non-zero number of fraudsters that are coming to attack your system. And when you have a fraudster, you don't want to send them, of course, through a fully automated process. You may want to fully automatically, with the benefit of all the machine learning models, know that this person or this applicant is highly likely to be a fraudster. But then once you've identified them as highly likely to be a fraudster, you want to send them through really as cumbersome a review process as you possibly could, as opposed to the opposite. And so that really is what's driving, what's always going to drive a small residual of manual loans. in theory, of course, if you got to perfect model accuracy where you never had a single false positive flag, then you would never have a single person that ultimately could get a loan that goes through that. But of course, because fraud is such a rare event, you're going to have at least some false positives because you're sort of always looking for needles in a haystack. And so I think that 8% manual number of loans will go down, but as a percent of applications, there's just always going to be some applications we send through the kind of like intensive fraud review channel, and that's a good thing.
And is there a particular type of fraud that's the hardest to sort of stop?
Yeah, for sure. So, when you think fraud, you often think of kind of like egregious, explicit fraud. And that really is what generally in the industry we call third-party fraud. And that basically means like someone else has come and stolen your identity. Maybe there's a sophisticated fraud ring. Maybe, these people are going out and kind of like tricking seniors who don't quite use the internet as much, all sorts of things that like this that could be happening. And in some sense, these are easier to detect because they have common patterns to their behavior, where it's a fraud ring, there's sort of multiple applications that happen at the same time, or there's data out there on the internet. Maybe they're kind of discussing their strategies in forums on the dark web, and it's sort of like actual data about it and patterns about it that you can detect. And of course, that is what AI is very good at doing. Then there's this kind of softer kind of fraud that I think you could even debate, is it really fraud? But what we sometimes call first-party fraud. And that basically means that a person has decided that they want to strategically trash their credit score in exchange for more money. And that's very hard. In some cases, it's really easy because there will be what we think of as signs of malicious intent. And actually, I think a lot of the non-traditional signals in our underwriting models and our verification models are really good at picking up stuff like this. If you think about stuff like, just like how fast you're doing things is kind of like, there's some unnatural speed that you might do things if you just don't care about repayment. Like, why do you even care what the monthly payment is if you don't intend to ever make a monthly payment, right? And so there's all these sort of like little signals that help with this problem. But I think in a very fundamental sense, like a very sort of planned kind of first-party fraudster that is intent on trashing their own credit in order to like get some money and like sort of knows the whole game and knows how to play it. That's something that at the limit I think is very hard to completely eliminate. And
assume that this is another reason why lenders choose your platform, because you help them to mitigate using AI against fraud as well.
Yeah, for sure. I mean, I think the history of traditional banks moving into online products where it's not a customer they've had a long relationship with, it's like internet walk-up traffic. I mean, that is a history where you talk to any bank and they'll tell you that there are just so many cases where that ends in these, super high fraud rates. We could be talking about like 5% of all the loans you've made turn out to be to fraudsters. And of course, that's just crushing from an ultimate financial perspective. And so I think a lot of the reason that traditional banks are reluctant to make new unsecured loans on the internet to strangers that they don't have a relationship with is there's just such a high chance that something goes wrong with that. And we give them the ability to do that, which is a big thing, because of course you want new customers, and new customers today are so much more likely to want to come via the internet instead of walking in a branch.
Mm-hmm. Amazing. And we'll swing back round to the Q2 numbers because they're really great. Revenue up, loans up, more automation. What changed in your strategy? Where's this come about from? Could you just give us more details about that?
Yeah. So as I said before, the single biggest source of growth for the company comes from wins in AI. And one of the big wins that we had in this past quarter was what we call an improvement to the meta model architecture. So our core underwriting model is actually an ensemble of different machine learning models. That means there are different algorithms that are used to learn from training data and make predictions about whether a particular applicant is going to repay or not. In fact, whether they're going to default or prepay in each time period of the entire loan's life. And we use these different kinds of learning algorithms, and then we blend the results together to get the final output. Now, when we do the blending, we actually are passing the outputs of the first layer of models into a second layer that we call the meta layer. The meta layer has also machine learning algorithms, and those algorithms are responsible just for figuring out the best way to blend the outputs of the sort of individual base models. And previously, we had neural networks as one type of model algorithm in the base layer, but we did not have it in the meta layer. And that's for various reasons, but I think the most general one you can think of as the more sophisticated your model architecture, the exponentially more training data that you need in order to make it work. Mm-hmm. And previously, we didn't have quite enough training data, and we didn't have quite enough compute or latency tolerance in order to have neural networks, which are one of the most powerful types of learning algorithms, in both the base and meta layer. And in the last quarter, we were able to change that. So now we have neural networks operating at both layers of the model, and that architectural change created a very large boost to model accuracy. And that boost to model accuracy unlocked these separation gains that allowed us to have higher approvals at lower APRs, and that drove a bunch of growth.
Okay, so it's mainly from people who were coming to your site asking for loans but were getting rejected, and this actually included them in the segment where they would be accepted now.
Some of them previously were rejected. Some of them previously were getting an APR that was too high for them to want to take out.
Yeah, got you. Which is really interesting. So it was coming from traffic and demand that you were already receiving. You just, like you said, improving the model. So how much, you mentioned earlier, because you spend a fair bit on marketing now. How is that a large percentage of revenue, and is that increasing? And how much is that becoming part of your business to generate demand as well?
Yeah, we certainly spend on marketing, though one of the cool facts about the company is that our CAC, the cost of acquiring customer, has actually been loosely speaking trending down over the years, and that's kind of the opposite of generally what happens in these businesses, where people think if you're a business where you're just kind of like skimming off the top, you found some little niche of people that were underserved before, and you reach those people, and then it's like you want to reach any more people, your CAC is generally going to go up because it gets sort of harder on the margin to find the sort of incremental person because you've already picked off the low-hanging fruit. And we actually have experienced the opposite dynamic, where we've been able to grow the kind of pie enough over time that I think the rate at which we're growing the population of people that we can be the best rate and best process for is actually happening faster than the rate at which we're kind of depleting the low-hanging fruit from a targeting and marketing perspective. And so we've been able to actually bring the sort of CAC of our business down, and all while sort of increasing our level of investment there. So I would expect that to continue. I think we don't have actually an aspiration for, we don't need from a business model standpoint for CAC to be any lower. We're perfectly happy to be where it is, or even higher is fine too. But we want to be able to keep investing more and more dollars in marketing and reach larger and larger share of the population as we have the right and best products for more people in more situations.
Mm-hmm. And just jumping around, sorry, because I remember things from earlier in the conversation, but we were talking about the AI algorithms again, the models. How do you make sure that it's being fair between two similar borrowers so they get treated the same way?
Well, my punchy answer is that only humans are capable of treating two similar people different ways. It's not actually something that like a computer or an algorithm can do. Computers are like really good at just kind of like following the data. And if, the data says two people are the same, then, the model's going to treat them the same. That's, all it cares about doing. But I think in a more serious sense, I think there's a really interesting debate to be had about, what does it mean for two borrowers to be similar? And I think this is the essence of the question that I think you have to answer. And one of the moats, if you will, around our business is that we've spent so many years and so much research time on this particular question. We've done it in partnership with major regulators like the CFPB. We've done it with major researchers at universities who are some of the kind of leading academics that publish papers on questions like what is fairness, how do you measure it, how do you test it in the context of a machine learning model, of these sort of like neural network models. And I think the gist of it ultimately that we get down to is the dimension of similarity that really matters is willingness and ability to repay a loan. At the end of the day, when you say two borrowers are similar, is it fair? What you really mean is if two people are both similarly able to repay a loan and you treated them differently, then there's something wrong. That's not a thing that I think we as a society want. But I think sometimes people have confused the input and the output, or the X and the Y on this question, where they say, well, what if two people with similar FICO scores get treated differently? And my answer is they should absolutely be treated differently, because unless the FICO score is the be all end all of whether you're willing and able to pay back a loan, it should not be the dimension on which we measure similarity for purposes of fairness. Because ultimately, what we want to know is, are you going to be able to pay back this loan? And I don't think it's in anyone's best interest for us to give loans to people who can't pay them back and are ultimately going to end up in bankruptcy or another kind of bad financial situation. So then the question is, okay, well, if what we really care about is finding similarity with respect to ability to repay a loan, then what we actually need to first have is the most accurate possible model for knowing if someone is going to be able to pay back a loan. And so you really don't want to benchmark against a really simplistic sort of traditional model. You want to benchmark against the most accurate available model that you've got and use that as the source of truth for likelihood of repayment, and then make sure that you're treating those borrowers in a similar way.
Mm-hmm. And slightly related, but if we look at general macro conditions, which affects people's ability to pay back loans, or and vice versa, when it's in different kinds of macro conditions, how do you prepare for or mitigate against loan delinquencies in bad macro conditions, and then change that when things get better? Is that all part of the model? Does it analyze economic conditions?
Yeah, so one of the things we've done over the last couple of years, partially in response to some of the learnings we had from 2022 or thereabouts, is that macro is really important. And rather than ignore it, we should figure out what part of the problem is tractable and solvable by AI, and be the best in the world at solving that particular part of the problem. Now, the reason I describe it as what particular part of the problem is solvable is that in the broadest sense, I think macroeconomic conditions are, of course, very subject to kind of idiosyncratic singular events that don't tend to have a long history of repetition. So meaning like, if you think about like COVID as a macro shock, well, there's never been a macro shock like COVID before. And of course, all kind of AI machine learning are based on training data that have sort of historical bases. And you're just not going to be particularly good at predicting that. Now, I don't think that's a weakness of AI per se, because I don't think there are like human experts that, if you ask them in 2018, we're going to tell you that in 2020, we're going to have the COVID pandemic, right? It's just like that was a kind of black swan type event. But unfortunately, of course, those things do happen in macro. And so what we eventually figured out was that like you're not going to be able to predict all of the kind of idiosyncratic black swan events, but you can be the most precise and the most quick to respond to any particular set of macro conditions and have it properly represented and priced in the model. And that actually is a pretty big edge, because it turns out that most of the ways that people measure macro are delayed by a fairly significant amount of time. We think of it as often with a 3 to 6 month lag. And that's because if you think about what are the indicators of macro? Well, the Fed publishes data. The Fed publishes data on the past quarter in the middle of the next quarter.
Yeah.
And oftentimes they end up revising that number for the next 2 to 3 quarters. Yeah. So to get like a real kind of estimate of what's going on in the macro, like you probably need to wait 9 months before you really know, what was the employment rate back in November of 2024. Like we're probably just really getting a clear picture of that today.
Yeah.
And there's a similar but less extreme story, even if you look at credit data, where maybe you can go to credit bureaus, but generally like people are looking at things like 60-day delinquencies as a key metric, or 90-day delinquencies. And well, guess what? You have to wait 60 or 90 days to measure 60 or 90-day delinquencies. And so you're just always lagged by 3, 6, or 9 months when you're kind of evaluating macro. And so we invested in building what we call the Upstart Macro Index, and actually behind the scenes, there's this whole suite of other tools that we'll figure out the right ways to surface over time. But what we're invested in doing is figuring out how we can make it so that we are just the fastest to respond and the most precise in responding. And our models today now have something that we internally think of as sort of this individualized macro component where we can look at any arbitrary set of characteristics that you've got. Maybe you're a high income person, maybe you're a low income person, maybe you're a person who works in nursing, maybe you're a person who works in the government, maybe you're a person who works in a tariff sensitive industry, maybe you're a person who doesn't work in a tariff sensitive industry. And the model can pick up trends that are individualized to that particular set of characteristics that you've got. Where if we see, for example, that maybe tariff sensitive industries are being more negatively impacted and defaults are just starting to creep up there. And when I say defaults, I actually mean, the first signs of delinquency is starting to creep up. The model can immediately pick that up and respond in real time. And it doesn't require people to specify like, oh, we're interested in, bucket A and bucket B and bucket C, because you just don't know what the next macro shock is going to affect precisely. And you want that to be something that the model can figure out for itself. And so that's how we've architected the model. And we think it's a very powerful solution for being the fastest to respond, most precise to respond. But again, we don't pretend that we're going to predict the next COVID, so to speak.
Yeah. That's amazing. That's it's pretty incredible how many areas there are to do improvements in the way it used to work. It just makes sense, right, that you should be quick at reacting to things like this.
Yeah.
Kind of incredible. So as you're picking up on all these new areas as you get deeper into the loans industry. What are you most excited about over the next 5-10 years in lending?
Most excited about over the next 5 to 10 years? Well, I think in probably, as we were talking about earlier, probably in 5 years' time, I think we'll have successfully brought AI lending to the parts of the consumer credit market that actually are big and matter to people.
Yeah.
So that's really, I'd say home and auto and some flavor of revolving credit are the three big categories. And I think when that happens, I think there's going to be a seismic move in how people perceive the relevance of AI and lending. Today, it's this weird niche thing that's just like maybe this cute little company Upstart does. Maybe they'll go away. Who knows? Or maybe they'll stay in their little corner. But I just really think that the perception around it is going to completely change when you bring it to these much larger markets. And I think when that happens, I think everybody is going to care about this. And the end result of that is I think you're actually going to asymptotically approach the real levels of access to credit that should exist in this country, which, as I said earlier, something like 80% of Americans should have access to bank quality credit. They should have it on demand with virtually no work required of them. And the other 20% should have a clear and defined path of how to get from where they are to where they want to be.
And what's stopping Upstart doing this, attacking those areas earlier?
We're working on it. As I said, we started in the home world on HELOC. Of course, each of these, you have there's a lot of work to do. And in some ways, each market has work that's specific to that market. So you think about like how do you actually become relevant in the auto business? Well, you have to be in car dealerships because that's where almost all auto loans happen. But car dealerships are, their own very specific industry with the way they work. And frankly, I think, we've had to spend a couple years like learning the ropes of like, okay, we have to really understand things like how do dealer markups work? How do add-on products work? How does like gap insurance work? Like the things that dealerships really care about, those were not things that, certainly I didn't know anything about them when I started this company. And I didn't know anything about them 3 years ago when we started in the auto lending business, because none of those questions were relevant in personal loans. But if you want to be a relevant player in a car dealership, you need to really understand those things. Your product needs to be very good at supporting those. And so those are things we've kind of figured out and iterated towards and gotten a lot of great wins on. Same in home. I think a different set of challenges that are home specific, but that we're working through. And again, I said earlier, HELOC has been a great sort of learning and testing ground for us to really figure out like all the mechanics of how you can most quickly and most efficiently figure out liens and titles and in co-borrowers, all of the pieces that you really need on a home loan.
Mm-hmm. Awesome. And so do you think Upstart will sort of exist as a mortgage broker sort of way? Like it will be one of the bigger players in that space and just, I think that they're the ones facilitating demand into different lending platforms at the moment, or would it work differently than that?
We certainly expect to be a big player in home loans. I mean, home loans, I think in some sense are when people think about credit. Why do they care about credit? It's because one day they hope to be a homeowner.
Yeah.
They hope to be able to, buy a house when they need it, and probably they hope to be able to get the loan quick enough that they can actually close on the home that they're trying to buy instead of running out the clock or someone else grabbing the
Mhm.
house. So I guess in that sense, I think it is inevitable that home is going to be a central piece of what we care about here at Upstart. It's just so big, so fundamentally important for the consumer. Now, within that ecosystem, there's a whole bunch of different ways that you can technically slot into the ecosystem. From are you a broker? Are you a correspondent? Are you a technology provider? Are you the originator? And I think we're not particularly dogmatic about which particular sort of way technically we're engaging, but ultimately we want it to be the case that if you come to Upstart, that you have a guaranteed way to ultimately get the home loan that you need. And when I say guaranteed, ultimately I mean either you can qualify today, you can get it instantly, you can get it with high predictability, really fast, or if you can't qualify today, we can help you figure out what needs to be true so that you can qualify and so that you can get the home loan that you need to sort of make your life happen. And as long as that's true for the consumer, exactly who's doing the originating and how it interacts with the GSEs and all that can be figured out on the back end.
And do you foresee moving into other regions in the future? I believe it's just US at the moment. Or is that, the US is such a gigantic market. Obviously, a lot of companies stay here for a very long time just because it's big enough to grow very big without going somewhere else.
Yeah, we are exclusively US based today. I would say we never say never about it. We certainly don't have any immediate plans to be outside the U.S. It is such large part of the world economy, but also I think in credit, in particular, consumer credit. Consumer credit is so big in the U.S. compared to outside the U.S. It just sort of really makes sense to start and focus there. But I do think there are really interesting credit access problems outside the U.S. that if you're thinking of the problem as where in the world is there the very worst access to credit, where there's the most amount of kind of undervalued consumers that aren't being served right today that could be served. Certainly there's a lot of interesting places outside the US, and we could be there one day.
Mm-hmm. Awesome. I've got a quick lightning round, if that's all right, where I'm just going to ask a few questions and
a
very quick answer to it. What is the bigger bottleneck for improving AI lending? Better data or more compute?
In the short to medium term, better data. In the long run, it's going to be latency. So a version of compute, not exactly compute, but kind of like compute.
Yeah. Okay. One input you wish every borrower had to share with you?
I would take everyone's driving records.
Okay. By 2027, which will LLMs be part of underwriting? We sort of discussed this. Yeah. What's Upstart's biggest moat in 2030? Data or distribution?
Data.
By 2030, what percentage of loan decisions will be made by AI? I think we're the wider market here.
100% of consumer.
Okay. One job in finance that AI will create, not kill. Or in tech, you can say widen it.
I think there's a real space for more financial counseling. I think that is something people want with an emotional human touch to help them work through their plans, their life plans, how it relates to money. I think money is it's a stressful thing for people, and I think we can make that process. We can make it quick. We can make it easy. We can make it delightful. We can make it your rates low. But I actually think if you take away all of that stuff and make it so instant, so easy, and at great prices for people, at the end of the day, you still need to decide how you want to live your life and, what kind of lifestyle you want to support. Do you want to spend more now, spend more later? And I think ultimately those are human questions.
Yep. And last question, one non-obvious book or paper that shaped your approach to business?
Yeah, there's this really long, super nerdy paper written by this guy Cliff Asness, who runs a fund called AQR.
Yeah.
And I don't quite remember the name of this paper, but he's the author of it. And it is a paper on the ways in which markets are efficient and inefficient. And the beauty of the paper is just that you really see, like, if you want to think rigorously about efficient markets and therefore inefficient markets, you have to think really, really hard because some of the smartest people in the world have worked on this problem. And if you want to find opportunities to generate alpha, to do better than market, do better than sort of the status quo, it's not something that you can just sort of do on a whim. It's something you need to take really, really seriously. And I think the ethos of that paper has stuck with me for all these years of building Upstart.
Awesome. Thanks, Paul. It's been a pleasure to have you on the show, and really interesting to dig into Upstart. It's definitely one of the companies to watch, and I'm sure everyone will value this interview a lot. Thank you so much. I don't know if there's anything else you'd like to leave with our community.
No, awesome. It's been great to be here.
Cheers. Thanks, Paul. Have a great day.
Hey, bye.